Hi there, JR here again with Sunflower Bank, Regional Sales Manager here in California. Today we're going to be going over a very popular topic, a conversation that we have with almost every client, and it's called buydowns. What are buydowns? How do they work? We're going to cover that topic today and hopefully be able to help offer you some understanding on how to be able to utilize this in your next conversation with your mortgage loan officer. Buydowns come in two forms, temporary and permanent. We're going to go over both forms today and I'll talk through them and help you understand them a little bit better. This conversation is a great conversation to have because it actually also goes alongside what you're planning on doing in your life, predominantly because that's really the way you have to analyze whether paying for a buy down or not. A lot of times people call buy downs points. Well, I don't want to pay points is what we hear a lot of, and that's okay. But let's make sure you understand what that really means, because technically in most circumstances, paying points means you're buying down the interest rate. Means you're going to pay a little bit more in fees to be able to get a better rate. And first part of the topic today we're going to go over is permanent buy downs. A permanent buy down is where you pay a certain amount to buy down the interest rate by a certain sum for the entire life of the loan, because that will be your rate. And the major rule of thumb when you're talking about permanent buy downs is, where is the break even point? How long before I start saving what it cost me to get that permanent buy down? As an example, if you were to pay 1 percentage point of a loan of $400,000, which is $4,000, you buy down the rate by hypothetical, and this is not an offer of credit or anything or interest rate. I'm just helping you understand how this works. But you could buy down the interest rate by, let's say, 0.25% or 0.3%. And the question is how long did it take that certain percentage to be able to recoup over time? Did it take 6 months? Did it take 1 year? Did it take 2 years? Did it take 3 years? That recoupment period is the most important question. And a good loan originator will take the time to help you understand that recoupment period, because it might have to coincide with what your life plans are. A hypothetical, let's say you're buying a house and you know that you're family planning and you're going to probably need a bigger house in 2 to 3 years. Well, if it takes 3 years to recoup the buy down, was it necessarily the right thing to do? Because you might not realize the full benefit of what you paid to buy down the interest rate. Now, granted, I should say, just as much as you can buy down a rate, you can actually take a rate that is a little bit higher than the standard rate with no percentage points paid. And that's called a premium. And that premium can cover your closing costs. We see a lot of people doing that today because we're in a higher rate market. And there's this anticipation that rates at some point will go down. But once again, a permanent buy down is when you pay extra to be able to get a better rate for the entire life of the loan. Now, where does that play into a part with a temporary buy down? Well, temporary buy down is just like what it says. It's a temporary reduction of the interest rate, but the mechanics are completely different. A temporary buy downs come in forms of a 3-2-1, a 2-1, a 1-1. And what does that mean? Well, it actually means a reduction in your interest rate for a temporary period. An example, on a 3-2-1, that's a 3-year course where the first year, the interest rate, your note rate, is actually reduced by 3 percentage points. And that means your payment is reduced by that same sum. Now, granted, your 2-year, second year, the rate will be reduced by 2 percentage points. And then in the third year, reduced by 1 percentage point. So as the years go on, you're going to come out with a 3% reduced interest rate payment, a 2% reduced interest rate payment, and then a 1 reduced interest rate payment in year 3. And so you'll see your payments step up during that time. Now, the question is, well, JR, why would I do that? Well, for many reasons. One of them is, let's just say hypothetically, it's your first time ever getting a loan and you're kind of worried about having to pay a payment like this. And, it might be the right step into homeownership. The second reason is you're planning on making a change over the next course of 3 years in income, or you just launched a business and, you want a few more years for the business to run before you start taking on a heavier payment. But what we are seeing the most of in today's market is seller concessions and or builder concessions that are in excess of your fees, that you want to make good use of the money that's being offered as an incentive to purchase that house. And so in those concessions, folks are using those in temporary buy downs because they could be able to reduce that interest rate. Once again, the mechanics in this are very important. So I'm going to go ahead and help you understand, how does it work over the course of time? Let's take an example, a 2-1 buy down with like a $400,000 loan. That 2-1 buy down, that payment on that first year will be reduced by 2%. The savings, essentially in interest over that time, is roughly about $6,000. In the second year, the payment will be reduced only by 1%. So you're going to see that payment step up, but it still has a reduction. That amount is roughly about $3,100. So you're talking about over the course of 2 years an interest that you're not having to pay on the payment. But what you have to do is you're going to prepay that interest at the start. You're like, JR, that's crazy. So I'm going to come out with more money out of my pocket to get a 2-year reduction in payment. Well, why don't I just make the payments as I go? Well, once again, going back to the example, if you have excess seller concessions or builder concessions, those excess funds can be used and or negotiated as part of your purchase contract to get those excess funds and to do that temporary buy down in interest rate so that you could be able to experience a lower payment over the course of those first 2 years. One of the major questions that comes up is, well, what happens if I move or I want to refinance or do something like that in the course of that time? Traditionally, and this is where I would say that you want to read the buy down agreement with the specific lender that you're working with, because in their buy down agreement, they will detail for you in what circumstances will happen. It'll also show you what happens with that money. So an example, that $9,300 at closing would be deposited into an escrow account. And those interest amounts will be added to your regular monthly payment to cover your full payment. You don't have to do anything. It'll all happen automatically, but the buy down agreement will help detail that for you. So you want to take a moment when you get your initial disclosures that you read through that buy down agreement to understand under what circumstances what will happen. So in regards to most buy downs, and I'll say most, what will happen during the course of those 2 years, let's say in the example that we gave, those 2 years, let's say in year one, you need to make a move, job change, you're going to move. Well, you still have, after year one, about $3,100, as we said earlier, in interest in that escrow account. What happens to that $3,100 traditionally will be credited towards the principal of your loan upon payoff. It doesn't just go away if you were to refinance or pay off the home. In most temporary buy down agreements, there is a clause for buy downs paid for by lender premiums. And so that's something you want to read about. Traditionally, those don't get credited. But if the buy down is paid by you or a builder or a seller concession, you will see that credit towards principal reduction at payoff. So that might help you understand a little bit better as to how these two tools in your financial planning of your mortgage can be used. Now, the real truth is there's many different circumstances. Your life circumstances, the financial markets, what's going to happen with interest rates, and all those things play together to really identify whether doing a temporary or a permanent buy down is the right thing to do. My encouragement to you is work with a pro who will take the time, who has the tools to actually represent it to you in a way that helps you understand it a little bit better. We have special worksheets that we utilize to be able to show our clients what will happen over time with those temporary versus permanent buy downs, whether it makes good financial sense. And all those questions are good questions to ask. You know, the simple thing is just take whatever rate at 0 points and move on with your life. But the reality is that might not be the wisest thing to do. Maybe paying for a permanent buy down is wise for you. And every given day, there's a difference in pricing because the markets move up and down. You never know where you're going to catch it at. So having these conversations with your loan originator, helping you understand how that might work for you, what's the best situation in your circumstances. You might not have a seller concession coming. Well, in that instance, is the temporary buy down even worth it? You could be using that money towards paying down the principal of the loan right out the gate. You can use it towards covering fees. You could do a whole lot of other things with it that might not make as much good sense as utilizing a temporary buy down. I would encourage you to take time and having that thorough conversation with your loan originator. I'm a loan originator and I would love to have that conversation with you as well. So definitely reach out to me if you'd like to talk through that, and appreciate your time today and hope this was educational. Thanks.